That is the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. We're joined now by Jared Blickery to get you up to speed on today's market action. Let's see where the major averages ended up here. They ended up in the green. Yes, we paired some gains, but you are positive across the popular averages. The Dow tacking on about 313 points. Your broad gauge, the S&P 500, is going to finish up about 0.8%. The NASDAQ finishes up about 0.6%. Small caps, the Russell, looks like that's going to tack on about 3% in today's trade. Looking over treasuries real quickly, we have relief there, 10-year back to 4.37. Jared, over to you.
Thank you. We are coming off the highs here, but somewhat productive day, and we'll take a look at the sector action in a second. Just wanted to get a closing look at the VIX. We are now under 30, and that's actually going to close in a few minutes there. Also want to check out the ICE B of A Move Index, kind of like the bond market's VIX, and you can see that's still fairly elevated, much closer to recent highs. And we can also check out the U.S. dollar, which ticked a little bit lower, as I said at the top of the 3 p.m. That's pretty close to 3-year lows, so something to keep in mind there. And here's the sector action. All 11 sectors in the green, led by real estate, utilities, and staples, and then healthcare. All 4 of those are the most defensive sectors, so kind of a defensively bullish day. We'll call it that, and move on to the NASDAQ 100, where we have a mixed board in terms of the mega caps. Apple up 2.21%. Let's get a year-to-date chart. We started off the day around up about 5%, and that's a month to date. There's the year to date. You can see we're still down almost 20% on the year. By the way, the Apple chart looks a lot like the S&P 500 and the NASDAQ itself. Meta and Amazon each down 2% and 1.5% respectively. Broadcom down about 2%, and some of the smaller issues, I would say they're skewing green today. And then just a brief peek at the Dow. We see a mixed board there. Aside from the mega caps, we're seeing some weakness in healthcare, specifically United Health. JP Morgan down about 0.2%, Disney off just a little bit. For the most part, seeing more green than red. And let's check inside the tech sphere. We have semiconductors, the bigger ones tend to be in the red here. NVIDIA only off by about 20 basis points. Mentioned before that Broadcom down about 2%. Taking a look inside software, aside from Microsoft, we have quite a few winners here. There's an equal weight, so you can see a lot more green than red. And then we'll finish here with ARK Innovation Fund components. That would be unprofitable tech, and kind of a mixed board here. We got a few in the green, a few in the red, and I'm going to send it back to you, Josh.
Thank you, Jared. Now let's bring in RJ Gallo. He is Senior Portfolio Manager at Federated Hermes. The firm manages more than $800 billion in customer assets. RJ, it is great to see you. So listen, RJ, it was another choppy day. Let's be honest, it's been a volatile stretch for investors. I'm just curious, you're talking to your clients, RJ, what are you telling them about what comes next, RJ? Do you think you can say with any confidence here, RJ, what's coming next?
Well, confidence has clearly eroded. The fact that the Treasury market has traded in about a 70 basis point range, I'm looking at the 10-year, in the last 6 or 7 trading sessions, it's pretty remarkable. We're in a position now where investors in the marketplace are starting to wonder if the confluence of a weaker dollar following the Liberation Day announcement, stronger gold, falling bond prices, rising Treasury yields, and falling stocks, it's starting to paint a picture. Is there a migration away from U.S. assets? Has the bold strokes of the Trump administration across many variables, to include the much higher than expected tariffs, to include the change in our geopolitical positioning, where we seem to be moving away from our traditional NATO allies, pushing our NATO allies to spend more on their own defense, where we have a debt to GDP of over 100%, and a third of our debt is in foreign hands, that the confluence of all those factors with a very bold and aggressive policy mix coming out of the Trump administration, both geopolitically and on trade, may actually be weakening the attraction of global investors to U.S. assets. And that's the real concern that emerged as Treasury yields were going up when you thought they should be going down, as a policy was revealed that would probably weigh on growth, yet yields were heading higher. So confidence has clearly eroded in the bond market.
Yeah, no question. And RJ, right now, there are so many cross currents. It's very, very difficult to trade. And yet, I last week had multiple clients come in and ask me how I felt about markets. I said, I think that the bark is worse than the bite. And they all wired money in, and we put capital to work. So U.S. investors, I have found surprisingly resilient, at least amongst my clients. Are you seeing any of the same as you actually step back from sort of the picture you just painted and actually talk to the investors of the firm?
Yeah, I would say this. I think that the bond market's reaction, although it reflected some of those things I just discussed, which are sort of scary things, for a very long time, investors have worried, when does the United States have too much debt? When does the United States take the advantageous position of the world's reserve currency and end up going a step too far? And there's some wondering whether, in fact, we might have done that. I would argue that the stark reaction in the Treasury market, where yields rose rapidly in a manner that surprised almost everybody, was partly exaggerated by the fact that in normal times, there are all kinds of sort of technical trades that'll be put on where investors, leveraged investors will be long treasuries and short something else, swaps, futures. And those trades were well known well before Liberation Day. And there was always a concern if you had a market destabilizing event, something that imparted a high level of volatility, that some of those leveraged trades might have to come off in a hurry. And I think that some of what we saw, the 10-year spiking to about 460, was exaggerated by that unwind of those heavily leveraged trades. And our view at Federated Hermes and the fixed income group has been that as that starts to heal, as those trades are finally unwound, that some of the more traditional variables that drive Treasury yields will reemerge, namely growth, inflation expectations, and expected fiscal and monetary policy. We have a lot more debt now than we've ever had before. Debt to GDP is at highest it's been since World War II. The amount of debt is, in fact, the biggest it's ever been. We all know that. And that can help to impart a lot of volatility in markets. But we've become more constructive. When the 10-year was at 460, we actually were looking to buy some treasuries. We felt that this was an attractive opportunity. And so far, that's worked out for us. I think investors as a whole, Federated Hermes, we have a large money market operation, fixed income and equities as well. So we look across the major public market asset classes, and we think investors are indeed concerned. But ultimately, I think the key is, will this cause a recession? And have we entered a period now where foreign investors are going to look at the United States differently? Our view on the recession probability has clearly risen. It's still not our base case, but a big slowdown is coming. And then secondly, when it comes to foreign investors, a lot's in the hands of the Trump administration. If they soften their message, if they walk back, if they enter negotiations, a lot of these concerns could probably be ameliorated.
RJ, you mentioned those big moves we've seen in the bond market. What about the moves in the dollar as well, RJ? I think it's the speed of the move that's got a lot of people's attention. I'm just curious what you make of that and the ripple effects you think investors need to keep in mind there.
It's a great point. I mean, I think that the concerns about global investors and their regard or disregard for U.S. assets were heavily linked to the confluence of the weakening dollar, rising yields, rising gold prices, and falling stocks all at the same time. Suddenly the phrase flight to quality meant buying some German bunds, which is pretty unusual. Again, I think the United States is not so far gone that we can't modify our course. The inverse of the current account is the capital account. The current account is mostly the trade deficit. We've got a huge trade deficit. President Trump doesn't like it. But remember, the inverse of that is the capital account, that those excess dollars that go overseas find their way back into the United States, where foreign investors buy financial assets here, U.S. stocks, Treasury securities. One of the big challenges that we faced here is if you put up big walls to trade at a time when you're pushing away some of your allies geopolitically, they might become concerned about just recycling their dollars into ever more financial assets in the U.S. If you soften your message, I'm not saying give it up. You can still have new trade negotiations. But if you soften your message, some of those concerns can clearly go back down, and the dollar would calm back down, and Treasury yields would calm back down as well.
RJ, great to have you on the show today. Thanks so much for your time.
Thank you.
Well, President Trump's tariffs sparking a sharp sell-off before pivoting his stance with a 90-day reprieve and special exemptions for tech. What does this mean for Trump's economic agenda? The Yahoo Finance senior columnist Rick Newman joins us now with a closer look. Rick.
Hey, Josh. So one of the things that markets have now told us is that Donald Trump's protectionism and his tariff agenda, it means higher interest rates. This is not a surprise. Higher tariffs mean higher prices, higher costs. That's inflationary. And when inflation goes up, and especially when investors think inflation will be higher in the future, long-term interest rates go up. However, Donald Trump wants high tariffs. He also wants low interest rates, and he has not been shy about saying this. He has already called on the Fed to be cutting short-term rates to try to get rates down. His Treasury Secretary says the 10-year Treasury rate is the main thing Trump is looking at. He cares more about that than the stocks, and yet Trump himself is the factor that is pushing those rates up. And if you think about what we got from the inflation report last Friday, if Trump took office, but he never launched a trade war, we would have long-term interest rates going down. We would probably have the 10-year below 4%. We would have mortgage rates coming down to around 6% and maybe lower. Trump wants all of those things, yet he himself is the one who is standing in the way of those things happening. So, this leads to a scenario for the next months and years where we're going to see, is he going to give up on tariffs because he wants to get rates lower? Is he finally going to accept that logic from the markets? Or is he going to try some unorthodox scheme to get rates down, even as his tariffs remain in place? And from what I'm hearing, that is sort of the new thing that investors are getting worried about.
So I have an idea for you, Rick, about this unorthodox scheme. And by the way, it's great to be on with you. Here's my theory, and maybe just from your reporting you can try to confirm or not, that if he wants to try to get inflation down, one way to do it is lower the price of oil. And how do you get oil prices down? You bring more oil onto the market. And I would argue that the reason he's pushing so hard for peace in Ukraine is you can bring Russian barrels back onto the market, and arguing perhaps for bringing Iranian oil back to market if they can curb their nuclear ambitions. Between the two, that's 5 or 6 million barrels a day of total worldwide production, 90 million. Do you think there's any thread of logic to that, Rick?
It's a rather circuitous way to get interest rates down, isn't it, to focus on oil prices? No, I don't think there's any logic to it. Another thing that is, we know what's happening with the OPEC nations putting more, trying to get market share from the American drillers. But another thing that is going to happen with falling oil prices is that American suppliers, who have a break even of $65 or $60 per barrel, which is close to where we are now, they're going to be producing less. And Adam, it gets to another way you could think about this is if you really wanted to get long-term interest rates down, just cause a recession. That would do it. And by the way, causing a recession also would help lower oil prices. So it gets, the cause and effect gets very tangled. There are some people who think Trump is a four-dimensional chess master, and other people think that he just has one idea and he chases it as far as he can. I'm closer to he's just going with gut instinct and there's no master plan, but I would be happy to be wrong about that.
Rick, thank you, buddy. Always great to see you.
Yeah, guys.
Auto stocks pushing higher as President Trump hints at potential tariff relief for automakers.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here.
Yahoo Finance's Praz Subramanian joins us here with more. Right, Praz, walk us through that soundbite.
Yeah, maybe some relief here for car companies. Don't know if it's going to actually address the auto tariff for the imports or actually the car parts part that he mentioned. Is it going to be a car part exclusion that we might hear about before the May 3rd deadline? So possibly some help. You saw the stocks go up here, GM, Ford, Stellantis all popping here today on that little soundbite. But obviously no clarity here. We're not sure what that means exactly. All we do know is that tariffs potentially could raise prices by $3,000 to $12,000 for your sort of mid-level cars. And it could result in 1.5 to 1.8 million lost sales this year if they're going to go in full on, as according to various reports. So big deal here for the auto companies. They need that relief potentially to stave off lost sales and potentially lost income too.
Yeah, and here's another one for you, Praz. Still China's critical mineral export ban that could weigh on the automakers. How does that factor in?
Yeah, I mean, this is the other side of the trade war, right? China saying, okay, you want to play with us now, we're going to cut off your, these 90% of the rare earth magnets for batteries and things like that, or sorry, motors come from China. 99% of the rare earth metals for other components, like those batteries and other things like drone equipment come from these minerals. So it's the second side of the coin here. I spoke to an official in the White House talking about how it's not certain that these exports have actually stopped. The Chinese put a licensing process in place, but other reports say the exports are stuck at port. They're not leaving until they get more clarity on the licensing process. So right now it's stuck, and that's a big problem.
Yeah, and we only have one mine, MP Materials, out in Eagle Pass, California, right, that actually makes the rare earths to make the electromagnetic batteries.
Yeah, even Musk tweeted about this last night, talking about how these rare earths are not rare. They're everywhere, but the question is, how do you refine them? And only China has the ability to mass refine these. We might have that soon, but not yet.
Right.
All right, Pras, thank you. Appreciate it. Coming up, Pfizer announced today it will discontinue its GLP-1 pill trial. We're going to get you the details as well as some analyst reaction on the other side. Stay tuned, much more market domination overtime coming up. Pfizer announcing today that it is halting a late-stage trial of its GLP-1 pill candidate. And Yahoo Finance's very own Angelina Kamlani joins us now with the latest. Anj.
Josh, that's right. We heard from Pfizer today that it is choosing to halt its phase 3 trial of danuglipron. That is its once daily oral pill that was supposed to be a really good competitor in the market. They said that they stopped it because one of the clinical trial participants had a liver injury and after getting off the pill was able to recover. So that is where things stand. This is, really a bumpy ride for Pfizer and the end to it, essentially, for this one molecule. We'll have to see what the company decides to do. If you take a look at the stock, though, it didn't really move much on the news today. Wall Street seemed to kind of shrug it off. And it seems that analysts are looking at maybe the company looking inwardly through its pipeline or externally to acquire something to get it into the obesity space. We got Akash Tiwari from Jefferies saying that we're removing danuglipron from our model and lowering the price target for Pfizer as a result from $34 to $32. And we view this as another frustrating hit to management's credibility. The company has really been under the watch of investors for some time. And you can see on your screen the struggle that it had to really enter this obesity space, already ending one candidate earlier on in June 23 because of similar liver issues. And then looking at twice daily danuglipron, having to scrap that, then advancing once daily, and now scrapping that as well. That leaves Eli Lilly as the only contender in the marketplace for a pill, as well as, of course, already a market leader with the injectable. So really hot obesity space that Pfizer is missing out on. And investors are looking at what it can do to really get the next blockbuster out of its pipeline. I guess we'll have to wait till earnings at the end of the month to hear more about that.
Well, Anjali, healthcare is such a big business, but if you get it right, you make a lot of money. Johnson & Johnson reports earnings tomorrow. Any wisdom what to expect?
Yeah, we're definitely keeping an eye on a few things for Johnson & Johnson. Of course, it is a maker of medical devices, which we know have been hit by the tariffs, as well as pharmaceutical manufacturing, which has been looked at as having some sort of special tariffs that we've heard from President Trump. So we're looking on any kind of impact from those conversations, as well as broader tariff impact on guidance. We've seen a couple of companies pull, and we'll see if Johnson & Johnson does so as well. We do know the company has committed to $55 billion in U.S. manufacturing, so we'll have to see how that all shakes out when the company lets us know tomorrow morning.
Anj, thank you. Appreciate it. Time now for what to watch Tuesday, April 15th. It's sponsored by Tasty Trade. Starting off on the earnings front, we're going to be getting some earnings from Johnson & Johnson, Albertsons, and United Airlines. United announcing results for the first quarter after the market close. Analysts expecting weaker demand to weigh on United's Q1 profit. Investors will listen closely for any commentary on the call about guidance. Last week, remember, fellow airline Delta pulled its full-year guidance because of uncertainty from President Trump's tariffs. Sticking with earnings, more bank earnings. They are on the way in the morning. That includes Bank of America, Citi, and PNC. Bank of America announcing results for the first quarter before the markets open. Analysts expecting that the big bank's profits from interest income could face pressure due to slower loan demand and shifting expectations for interest rates. And moving over to the Fed, we're going to be getting some commentary from Fed Governor Lisa Cook. This is coming after comments today from Fed Governor Christopher Waller. Waller saying that he's expecting the impact of tariffs on inflation to be temporary. And finally, if you're still working on your federal tax filing, now is the time to get it in. The deadline to file your 2024 federal income tax return is tomorrow. Well, that is going to do it for today's Market Domination Overtime. A big thank you to Adam Johnson for hanging with me today, Adam.
Thank you, sir.
I told you, Julie Hyman was going to be out this week. I said, bring me Adam Johnson.
Well, here we are. It's Monday. We're in it. I hope Julie's having a fine day.
Yeah.
And we certainly have had a fine day, so thanks for having me.
It was great to have you here. Appreciate it, my friend.
Thank you.
Don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.